Hello, hello, hello. Welcome. For those of you who are watching me for the very first time, my name is James Ambroise, and on this channel we cover how to pay off debt faster than any other debt repayment method out there. We cover basic bookkeeping and accounting for someone who just started out a small business. We cover basic personal income tax to include a Schedule C, Schedule E, depreciation. I am also the author, creator of Ambroise Method 1.0 and Ambroise Method 2.0. Ambroise Method is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to debt snowball, debt avalanche, velocity banking. Real quick about my credentials. I have been or am a bookkeeper and accountant, QuickBooks Pro advisor, senior tax advisor, residential real estate investor, residential property manager, financial coach. And as always, before we get started with what's on the board, please allow me to shout out the name Jesus, my Lord, my God, my Creator. Thank you. All right, America, on the board we have this hypothetical scenario of somebody who filled out one of my Microsoft Excel worksheets, and the person provided me with these figures for debt. We're doing two separate examples so I could illustrate my point later in the lesson. So for debt, we have credit card A, credit card B, credit card C, and an HELOC. That's for example number one. For example number two, we have credit card A, credit card D, and an HELOC. Okay? The original loan amount, the credit limit, $13,000. APR, 29.99%. Balance owed, $0. Monthly payments charged, 0. Availability, America, remember from prior lesson that the availability is the relationship between the credit limit and the balance owed. That relationship calls for a subtraction operation. 13,000 minus 0. That's how we arrive at 13,000. Okay? Credit utilization. Credit utilization is the relationship between the balance owed and the credit limit. That relationship calls for a division operation. So 0 divided by 13,000, that's how we arrive at 0%. Okay? Payment risk charge. Payment risk charge is the relationship between the monthly payments charged and the balance owed. That relationship calls for a division operation. 0 divided by 0, that's how we arrive at 0%. Okay? On our note, we're saying for credit card A, the grace period, we put down 2 cycles. And we're going to go into greater details about this grace period a little later in the lesson. For credit card B, grace period got dropped or got lost. Okay? For credit card C, the grace period, well, credit card C has no grace period at all. Okay? And the HELOC is in the drop period. Let's take a look real quick at the second example. Credit card A, same thing as this credit card A. 2 cycle, just like we had earlier. Credit card D, the grace period got dropped or lost. And again, we're going to go into greater details about those things a little later in the lesson. And the HELOC is in the draw period. Okay? Now, these are some of the bills that could go on a credit card. We have electricity. Electricity could go on a credit card. Water, utility TV, Netflix, cell phone, beauty and skincare, clothes and shoes, insurances, life insurance, auto insurance, all kind of insurances, fuel, gas, dining at restaurant, and groceries. All these items, every single item that we have on the board could go on a credit card. Okay? And this number here is the day of the cycle, not the calendar date, folks. but the day of the cycle, like day 1, day 2, day 3, day 4, day 5. So for this item, they, they, they're gonna go out on day 26 of the cycle. Okay? Fuel gas, this usually doesn't have a due date. Okay? So we're gonna figure out when these items needs to go out, what day of the cycle these items needs to go out. Okay? Alright, America. We're doing a scenario for a financial coach. And the question financial coach posed to me, asked me was, James, can you please do a lesson on credit card float? Okay. And today we're gonna do part 1. Okay, credit card float, part 1. Okay, and maybe somewhere down the road, I'll probably do part 2. Okay, not back to back. Okay, part 1 and then some different lessons, and then somewhere down the road, I'll probably do part 2. Okay. All right, folks. Again, we're doing a scenario for financial coach, and the question financial coach asked me was, James, can you please do a lesson on credit card float? Okay. All right, America. There are still a few items or a few lessons that I have not covered yet. Okay. Consolidating the due date of your bills, of your expenses. This item, we're gonna cover this item today. Okay. Credit card float, like I mentioned, we're gonna cover that one today. Debt consolidation or debt refinance, this one's gonna be somewhere down the road. And 3 or more alternative accounts simultaneously. Okay, that's using not 1, not 2, but 3 separate alternative accounts at the same time. So in the same calendar month, or in the same billing cycle, or in the same cycle, I should say, we're using not just 1, not just 2, not just 3, but well, 3 or more alternative accounts simultaneously. So if you belong to this other group called Velocity Banking Group, it would be like using 3 or more different debt weapons at the same time, in the same calendar month or in the same cycle. Okay? Not over multiple cycles, in the same cycle, in the same calendar month. All right, folks. Today is case study number 22, and today's date is July 18th, 2026. Okay? That is the day that I'm doing the video. Alright, America. I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to start with the exercise. Alright, America. Again, the question that financial coach asked me was, James, can you please do a lesson on credit card float? Okay, and this one's going to be part 1, folks. All right. All right. America, when you're paying off debt, with regards to a credit card, you're going to come across something called a billing cycle. Let's put that over here. Billing cycle. Okay. The billing cycle with regards to a credit card is typically 28 to 31 days. Let's see. Let's put down credit card over here. And let's put down HELOC since we have credit cards on the board and an HELOC. Let's also do one for HELOC. And again, the billing cycle with regards to a credit card is typically 28 to 31 days. Folks, during this lesson, every time I use the word typically, know that we have at least one exception, okay? One exception. So 28 to 31 days. Okay? So 28 days, 29 days, 30 days, 31 days in the billing cycle with regards to a credit card. Well, James, what about an HELOC? Same thing. HELOC, the billing cycle could be 28 to 31. Okay. Now, because our government allow the big bank, the big creditors to do whatever they want, we have a different kind of billing cycle. So, put down billing cycle again. This time, this billing cycle is not 31 days. It will be 32 days. So 3-2. Okay. So 28, 29, 30, 31, 32. Okay. And we're gonna, during the lesson, of course, we're gonna cover some of the reasons as to why a billing cycle might be 32 days. Okay. And for HELOC, same thing, could also be 28 to 32. Okay. And again, folks, we're gonna go into greater details a little later. Give me an opportunity to put some items on the board first. Okay. And again, folks, our government, again, allow the big bank, the big creditors to do whatever they want. We have another kind of billing cycle. So far I have 3 different billing cycles on the board. And this billing cycle, America, could be shorter than 28 days or longer than 31, 32 days. So we're just going to put shorter or longer. When it is shorter, so shorter than 28, could be 27, 26, 25, 24, 23, any number shorter than 28. Okay? Longer than 31, 32, so it could be 33, 34, 35, 36, 37, 36, 30, 30, 33, 34, 35, 36, 37, 38, 39, 40, 41, and so on and so forth. Some of them stop at 45, but again, it could be shorter than 28 or longer than 31, 32. Okay? So what about an HELOC? Same thing, shorter or longer okay? Now, after the billing cycle, you're going to come across something called the statement closing date or the statement date. So statement date or statement closing date. Okay. And the the statement date or the statement closing date is, think of it, America, as the last day of the cycle. So let's just put last day of. Okay. Same thing for HELOC, last day of. So for a cycle there's, let's just use the first one. For a cycle there's 28 days. The statement closing date will be the 28th day. For a cycle there's 29 days. The last day, the statement closing date will be the 29th day. For a cycle that have 30 days, the statement date will be the 30th day. For a cycle that have 31 days, the statement date will be the 31st day, okay, and so on and so forth. So the last day of however how many days that the cycle has, that last day, that very last day is the statement closing date or the statement date, folks. Okay. So allow me to put one more item on the board. We have the grace period. The grace period with regards to a credit card could be 21 to 25. Okay. By law, with regards to a credit card, the grace period has to be at least 21 days. Okay. But some of those credit cards, their range is 21 to 25. So 21, 22, 23, 24, 25. Okay? But based on federal guidelines, it has to be at least 21 days. Okay? The guidelines doesn't talk about any cap. Okay? Guidelines only refer to the minimum days he has to have, at least 21. Okay? So which means if these people wanted to, they could have a grace period 26, 27, 28 if they really wanted to. Okay? Because okay, the guidelines only 21 days, at least 21 days. Okay? And this grace period is well, we're going to talk about different type of grace period. This particular grace period is how many days after the statement closing date that your bill is due. Okay? So, say for example, it's 23 days. And your statement closing date was, say it was on the 2nd. Okay? The statement closing date was on the 2nd. Statement closing date. And then we're saying that we have a grace period of 23 days. So if we had a grace period of 23 days, so 23 plus 2 will be 25. Okay? So your payment due date will be the 25. Okay? Using a calendar month. Okay? Alright, so right after the grace period, we have payment due date, like I've just mentioned. And just like the statement closing date is the last day of the billing cycle, while the payment due date is the last day or whatever period that they gave you. Okay? So last day of. So if they give you a grace period of 21 days, well, your payment due date going to be the 21st day. If they give you a grace period of 22 days, your payment due date will be the 22nd day. If they give you a grace period of 23 days, your payment due date will be the 23rd day, and so on and so forth. That is the last day that you could make the payment. Okay, you could make the payment anytime earlier than that, but the last day to make the payment will be that day. Okay, based on the grace period, based on how many days that they gave you on the grace period. Okay, otherwise, with regards to a credit card, you're gonna be incurring some late fees. Okay, so. Well, James, what about the HELOC? Since we have HELOCs on the board, well, the grace period. For HELOC, some of them follow similar paths or similar route as a credit card. So the grace period on the HELOC could also be 21 to 25 days. Okay? But unlike the credit card, remember, federal guidelines have to give you at least 21 days. For the HELOC doesn't have no such requirement. Okay? But most of HELOC, like I mentioned, they follow similar path as a credit card. So they could also give you 21 to 25 days. Now, because for the HELOC America, they are under no obligation to give you 21 to 25 days, to give you at least 21 days like a credit card. Okay? So sometimes this could be the same as a credit card. Let's just put same here. So when it's the same as a credit card, so 21 to 25, or different. Okay? So when it's different, obviously it is not 21 to 25 days. Okay? And again, folks, credit card got their own set of rules. HELOC doesn't have to abide by that rule because the HELOC is not a credit card. Okay? So it could be the same, 21 to 25, just like a credit card. It could be different than the credit card. Okay? And what about the payment due date? Same thing. Last day of, that's the deadline. Okay? You could pay your bill, your payment due date. You could pay your bill anytime earlier than the last day. Okay? But depends on the lender. Okay, if you don't make your payment on the last day, on or before the last day, there might be you might have some issues. Depends on the lender. And we're going to get to that a little later in the lesson. But for now, give me an opportunity to build you guys this little cheat sheet. Because this thing could be very complex. Okay? I watched quite a few videos. And I've seen some of my competitors talking about this thing the wrong way. Okay? So that's why I want to create this cheat sheet and trying to break it down the best way that I know how for you guys. Okay? Now, and we're going to continue to keep building this cheat sheet. But now let's go back to this billing cycle. Earlier, America, I mentioned to you guys that a billing cycle is typically 28 to 31 days. Okay, since we have different type of billing cycle, different variations of it, let's call this one the standard. Okay. All right, because most of you guys are pretty familiar with 21 to 31 days. Okay. Now, James, when could be a reason why a billing cycle might have 32 days? And again, the standard is 28 to 31, but we have this one, 28 to 32. Okay. Again, folks, our government allowed these big banks, these big creditors to do whatever they want. One of the reasons could be that the billing cycle, according to them, falls on a weekend. let's put down weekend. Okay. Another reason could be the billing cycle falls on a holiday. Holiday. And another reason could be in a leap year. Okay. All right. Now, let's do one more. On the board, I have shorter or longer than 28 days, shorter or longer than 31, 32 days. When can a billing cycle be shorter or longer than 28 to 31 days? Well, shorter than 28, longer than 31, 32. One of the reasons, according to them, could be on your very first statement. So first statement. It could be when you change the due date. So change due date. Or it could be when the creditor themselves has to make some form of adjustment. So adjustment. Okay? All right. Now, let's start digging deep in those things. We say 28 to 31 days is a standard. (21 to 32 days), when it's 32 days, it's because, say for example, the billing cycle falls on a holiday, on a weekend. Let's put some days on the board. We have, for example, let's put down Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday, Monday. Okay? Say for example, the 31st day was going to be on a Sunday. Okay? A lender may not want the billing cycle to fall on a Sunday. So basically, they don't want to close the books on a Sunday, so they're going to push it by one more day. Because again, remember, the Sunday is a weekend. Okay? So, say for example, the 31st day is on a Sunday. They don't like that. So, instead, they might want a 32-day cycle. Okay? Because they don't want to close the cycle on a weekend, on a Sunday. Okay? So it's going to be over here. So it's going to be the Monday instead. Okay? So this one will be the weekend one. Okay? And for a holiday, let's assume that the 31st day was on a Monday, for example. Okay? So they're going to want, since the Monday is, let's assume the Monday is a holiday, so they don't want the billing cycle to close on a holiday, so they're going to push it by one more day, so it's going to be the Tuesday instead. Okay? So this one is the holiday one, as an example. And in a leap year, in a year they have 366 days, they might push it to 32 days. So your cycle will have 32 days instead of 31. Okay. America. Earlier I mentioned that our government allowed these big banks, these big creditors to do whatever they want. Let's talk about the weekend one for a second. Again, for some lenders, not all, for some lenders, if the cycle closes on a weekend, so Sunday is a weekend, they're going to want to push it by one more day because they don't want to close the cycle on a weekend. Okay? Now, why do the government allow big bank or big creditors to have a 32-day cycle? Okay? Because last time I checked, we don't have any calendar month that has 32 days. So why then is a lender allowed to have a 32-day cycle? Okay? It is true that they don't have to follow the calendar. The calendar of the billing cycle doesn't have to match, I guess, the calendar month. Okay? But there shouldn't be any reason, America, why a billing cycle has 32 days. Okay? And again, the reasoning is, well, we don't want to close our books on the weekend. Okay? Or on a holiday. Or on a leap year. So that's why we're going to have this extra day. We might have this extra day. Okay? Remember, America, most credit card companies, they charge us interest. Most of them, they use an average daily balance, including new transactions with compounding, most of them. So average daily balance. Okay? So they have no problem charging us interest on the weekend. And again, the way they arrive at the monthly interest cost for the cycle, the formula that they use, most of them anyways, is an average daily balance, including new transaction with compounding. So the interest is compounding daily. Okay? And again, they have no problem charging us interest on a Tuesday. No problem charging us interest on a Wednesday. No problem charging us interest on a Thursday. No problem charging us interest on a Friday. No problem charging us interest on a Saturday. But wait a minute, the Saturday is a weekend. No problem charging us interest on a Sunday. No problem charging us interest on a holiday. They have no problem charging us interest on those days, but when it comes for them to close their books on those days, they don't want to do it. They could charge us interest on those days, but they don't want to close their books on those days. Okay? But instead, they want to push it by one more day. So 31 becomes 32. 31 becomes 32 on a holiday one, if Monday was a holiday. So you meant to tell me these companies, some of them are billion-dollar companies, some of them are trillion-dollar companies, some of them are gazillion-dollar companies. Okay? They don't have a computer system that will account for the billing cycle falling on a weekend. So you meant to tell me that those billion-dollar companies, those trillion-dollar companies, they do not have a computer system that will account for a holiday? That the billing cycle falls on a holiday? Well, James, why would it matter if they charge us an extra day of interest? Because then again, this is for the billing cycle. Okay? Okay? This is the cycle that the billers on. This is the number of days that the billers on. So if you went from 31 to 32, in this example, that means they are billing us for one additional day. Okay? And again, for those of you who might wonder, well, what's the problem? Okay? Because if they push it by an additional day, which means they could, I guess, what's the word? They could balance it out on the following cycle. Folks, that's not how it works. That's not how it works. And for those of you who don't quite understand how numbers work, and again, most of these lenders, they're charging us on an average, they're using an average daily balance, including new transaction, with compounding. Okay? So, if a lender let the balance grow, because remember, they're charging you interest on the balance. Okay? So if they let the balance grow, so balance grow goes for one additional day. Okay. Well, let's see real quick how much that could be. Let's use an example, because when we add all these up, the total is 3,000. Let's assume that on average, people have a balance of 3,000. And we have a credit card, let's just pick one of the, we have this credit card, 29%. Okay? Let's see how much that one additional day of interest will cost us. Okay, if on average, the customers has a $3,000 balance, because when we had these up, we had 3K. Okay, so 3,000. Okay, and again, it's an average daily balance. Let's say what, let's say that including new transaction with compounding. Okay, let's use a simple formula just to make my job a little easier. And we're saying we were here at 29%. So let's convert this 29% to a daily rate. So 29 divided by 100 divided by 365. So we are at 0.0007945. Let's stop right there. Okay, and we say it was 3,000. On average, and we say for one single day. Let's see how much interest that is if we use this simple formula to make our job a little easier. So 29%, so 29 divided by 100 divided by 365 if we're using a 365 for the year, okay, times 3,000, okay, times 1 day. So each day, this particular lender will earn $2 if we're using a simple formula, $2.38. That's the additional interest that they are earning, okay? And again, for those of you who don't quite understand how these numbers work, remember, we're saying on average, this is how much they're making. Let's assume there are about 40 million customers that they have, averaging that amount on that balance. So we're looking at 95 million and some change. Well, let's assume, James, because 40 million is quite a lot. Some of them don't have that many customers that they're charging on average 29%, and they push the billing cycle by one additional day. Let's say it was only 900,000. So you will still have $2.38, okay, times, let's say it's only 900,000 customers that they have, they're charging that kind of money. So 900,000 times $2.38. So we are at 2,142,000. Folks, this is how much money they are making, okay, based on the condition that I laid out, okay, per single day. So for one single day, 95 million, if it was 40 mil, 2 million and some change if they only have 900,000 customers or clients. So to you guys, it might only be $2.38 in interest for that day. Okay. And when you times that by all this volume, 900,000 customers or 40 million customers, okay, most of these banks, we don't even know how many customers that they have, because they will, some of them, all of them really, but let's just say some of them will not even release that information to let you know how many customers they have or how many credit card customers that they have. Okay. Folks, 95 million or even 2 million, this is the kind of money you'll never make, most of you guys, you'll never make in your lifetime. Okay. Well, James, why then they want to push the billing cycle by an additional day? Why don't they have it shorter than 28 days instead of the longer one? Because 32 is longer than 31. Okay? Or sometimes even, so, because on the board I also have shorter. Okay? So if they really want to, it could be shorter than 28. Okay? And we're going to talk about that a little later. Now, that was the weekend, that was the holiday, that was the leap year, that they want to push it by one additional day. What, James, about the first statement? Say, for example, America, you apply for a credit card, whether you fill out a paper application or you did it online. Most people, they do this thing online nowadays. So you went online, you applied for a credit card, and the credit card got approved, so you got approved. Once you get approved, they'll tell you, well, you might take, I don't know, depends on the lender, 5, 7, 10 business days or even longer before the credit card, the actual physical credit card arrive in the mail. Okay? So, first, I had to apply for the card. Then they have to process all of that by mailing it to me. Then, once I receive the card, I have to activate the card. After I activate the card, I have to start using the card. So some of them, the first statement will be, let's use the longer one, will be a period, a billing cycle. Your very first statement will be a billing cycle longer than 31, longer than 32. Let's assume that your billing cycle is like 36 days. Because again, on the first statement, the billing cycle could be longer, okay, than 31, 32. So let's say it's 36. 36-day billing cycle. So they're going to charge you interest on 36 days. Okay? Well, it depends when you make the purchase. You know, if you make the purchase on day one, it'll be 36 days. Okay. Now, when you also change the due date, let's say because you changed the due date, remember you used to have a due date that was different and you call them up to change your due date. So for that reason, that billing cycle could be longer as well. Okay, when they make an adjustment themselves, the billing cycle could be longer. Okay, so all these reasons are why billing cycle could be longer. Why then most of them will choose to charge you on a longer cycle as opposed to a shorter cycle? Because they could do a shorter cycle, folks. Say for example, for a cycle that's 36 days, let's say it was 5 and 31. Because 5 plus 31 is 36. So the shorter cycle will be just 5 days. The normal cycle will be 31. So 5 plus 31, 36. Or it was 6 and 30. Again, 36, 36. And again, 6 plus 30 is 36. The shorter cycle in this case will be 6 days. The longer cycle will be 30 days. Okay. Let's use another example where the cycle is like 45 days. Okay. So in this case, we probably have 45 could be, let's say, 31, 14, or 15, 30. Okay. 45, 45. Okay. For this scenario, the shorter cycle will be 14 days, then the normal cycle will be 30. Or the shorter cycle could be 15, the normal will be 30. Okay. Why do most of them prefer to do a longer cycle? Which means they have an opportunity to do a shorter cycle. Okay. They could send us a bill for the shorter cycle, and then say, for example, the shorter cycle, and then with regards to a credit card, remember they have to give you at least 21 days for grace period before your payment is due. So it would have been 14, and then let's say it's 21 plus an additional 21 days, okay, before the payment is due, payment due date. Okay, if it's 23, so 14 plus another 23 days before your payment is due. So 14 would have been the billing cycle, plus an additional 23 days grace period, then you arrive at your payment due date. Okay. Again, why they don't like to do the shorter one, they prefer to do the longer one. Okay. It's because these folks, they understand how numbers work. Okay. This will be one of the few times you owe them money, because remember the shorter cycle would have been 14 or 15 days or 5 or 6. You owe them money, they don't want to collect the money. And again, folks, this is the only few times when you owe them money on the shorter cycle, they don't want to collect it. Why? Because they prefer that the balance, okay? Say for example, the balance after 5, 6 days was, I don't know, let's call it 3,000. Let me erase some stuff on the board just so I can illustrate this thing a little better. So say after 5-6 days or after 14-15 days, the balance was 3K. Okay? So why they didn't send us a statement with the 3K plus interest? Why they prefer to wait 36 days in the case of these two, or 45 days in the case of these two. Okay? America. Again, remember bank charges with regards to a credit card, most of them, average daily balance, including new transaction with compounding. If they allow this 3K plus interest, that balance to go unimpeded for 45 days or unimpeded for 36 days, okay, undisturbed for 36 days. If they allow this balance to go undisturbed for 36 days, if they allow this balance to go undisturbed for 45 days, they'll make more interest on you. Remember, again, it's an average daily balance, including new transaction with compounding. So compounded, on the compounding aspect, that's interest on top of interest. Okay? Now, if they sent you a bill for the shorter cycle, say 5-6 days or 14-15 days, okay? Because remember, the bill gonna come 21 days, that's the grace period. 21 days later, with regards to credit card, the government has to give you at least 21 days. But most of them uses 23 days, 24, 25 days. Okay? So, which means after 21 days, you will be forced to make a payment. Okay? Because remember, your payment will be due after 21 days. Your payment will be due after 23 days if they're using a 23-day grace period. Okay? So, let's say 21 days. So, your payment will be due. And what does payment do? Payment gonna reduce the balance, no matter how big, okay? Because most of it gonna comprise of interest plus principal. So a little tiny bit of principal, okay? So that payment, so there goes the balance 3K plus interest. Then you have to make a payment minus the payment. So the balance now gonna be a lot less, because again, payment gonna reduce the balance. So you're gonna have a lower balance. Okay? I hope you guys understand this thing. So they prefer not to send you the bill. They prefer to wait because they do not want you to break up the balance, to reduce the balance. And again, if you have a lower balance, that means they're gonna make less interest. They're gonna make less interest. If you have a bigger balance, okay, for not sending you a bill, so the balance is gonna keep growing, okay? And again, folks, the grace period is only 21 days, which means, okay, after 21 days, you're gonna be forced to make a payment. If the grace period is 23 days, which means on or before 23 days, you're gonna have to make a payment, okay? That payment gonna reduce the balance. Which means overall you're gonna pay less interest because you're gonna have a lower balance. Okay? In the beginning, that 3K is only 3 and some change. After 5-6 days, but after 36 days, that 3K gonna keep balloon up, okay, to something much greater because it's compounded every single day. So it's interest on top of interest on a much higher amount, on a much higher balance. So that's how you're gonna end up paying more interest. Okay. And again, this is one of the few times that a lender, you owe them money, they'll prefer to wait, because by waiting, they are making more interest on you. They don't want you, they want to give you an opportunity to break up that balance by making a payment, by forcing you to make a payment. After however how long, 21-day grace period or 23-day grace period or 25 days grace period. Okay? So that is why the very first statement for most of them, because these people, they're very crafty. Okay? Your first statement gonna be usually greater than the standard, which is 21 to 31 days. Okay? So every time I mark out that you have a billing cycle that is greater than 31 days, okay, know that you are being robbed legally. Okay? Again, just on one day, based on whatever volume that they have, with regards to the number of customers, this is how much money they're making just in one single day. Imagine 36 days. Well, that's more than one day. That's 5 additional days. 45 days. Well, that's more than one day. That's 14 additional days. Okay? So imagine, on one day, this is how much they're making. Okay? Imagine if it was 5 days. Not 1, but 5. Imagine if it was 15 days. Not 1, but 15. Okay? On one single day, folks. Again, this is more money than you're going to make in your lifetime. Now, we have a few federal guidelines that govern these things. C.A.R.E is one of them, Truth in Lending Act, and we have this so-called Credit Card Act. Why then they did not fully cure these issues with those federal guidelines? Okay. Not only you have these federal guidelines, remember that Congress makes the law about these things. Congress, that is the Senate and the House of Representatives. And you also have the so-called enforcer, which is c.f.p.b. Put that on the board. c.f.p.b. Consumer Financial Protection Bureau. Okay? These are supposed to, they could also make some rules, and they have to enforce these things. Okay. These two groups, well, the federal government in general, okay, they are allowing the big bank, the big creditors to do all this nonsense. Okay. Because there's no reason for a billing cycle to have 32 days. There's no reason for a billing cycle to have 36 days. There's no reason for a billing cycle to have 45 days. Okay. Another reason that they might give you would be, well, James, in order for us to keep giving the customer the same payment due date every month, okay, sometimes we have to push. Let's just use this one. Sometimes we have to push the billing cycle by one day. Okay. With regards to a credit card, let's talk about that one real quick. We want to give you, say for example, this particular lender uses a 23-day cycle. you'll be 32. Let's use this one. Let's say it falls on the weekend. So which means Saturday would have been the 30th. Okay. This one would have been the 29th day. This one would have been the 28th day. Okay. We're using the 32 days. Okay. And again, they're saying that this thing falls on the weekend. Let's say 7, 14, 21. So let's just use 21 days then. To also make the payment due date falls on the weekend. Again, 7 days, 14 days, 21 days. Okay, so that's the grace period. So we have a grace period of 21 days. So let's say they're saying not only the billing cycle falls on the weekend, your payment due date also falls on the weekend. Let's just go crazy with it. Okay. Now, remember, America, by law, with regards to a credit card, they have to give you at least 21 days. Okay? So, let's say this one falls on the weekend. The payment due date falls on the weekend. Okay? Let's kind of go crazy with it, just to kind of debunk, okay, some of this nonsense that they're talking about. Well, if our billing cycle falls on the weekend, James, we have no choice but to push it by an additional day. Because either A, we don't want our billing cycle to fall on the weekend, or B, we want you to have the same billing cycle. Let's say your credit card is due on the 21st of the month. Say this was for 23 days something. Okay. Let's say your billing cycle is on the 23rd of the month. I'm sorry. Okay. Because most of these credit card companies, they like to use, most of them, they like to give you 23 to 25 day grace period. Okay, so let's use the 23rd one. Okay, so just to make things a little easier, you know, so you guys could follow this thing, because this thing could be a little complex. I want you guys to follow it. So your payment due date was on 23rd. Okay, they're using a 23-day grace period after the billing cycle for your payment due date. So your payment is on the 23rd. Okay. So on a weekend holiday or a leap year, let's touch this leap year as well, because I did touch it before. Okay. Your payment has to be on the 23rd, because they have to give you 23 days. Because maybe the 22nd, I don't know. So they have to push it. For whatever reason, they have to push it to give you the due date that you want. Okay? 23-day grace period. Your bill's due on the 23rd every month. Okay? Or even 22-day grace period. Whatever the number of days is. Remember, America, with regards to the grace period, the federal guideline states that he has to be at least 21 days. At least 21 days. So long that they have this 21 day, okay, they are fulfilling the requirement. At least 21 days. Which means if they really want to, it could be 22, it could be 23, it could be 24, it could be 25, it could be 26, it could be 27. If they really want to. Okay? They don't have to stop at 25. The guideline doesn't tell them, doesn't put a cap on how many days that the grace period has to be. All you say, he has to be at least 21 days. Well, 22, 21 days is in 22. 23, you could find 21 days in 23 days. 24, well, there's 21 in there. 25, there's 21 in there. 26, there is 21 days and 26 days. 27, there is 21 days and 27. Okay? So why then they don't go back to give you a cycle of 28 days? Because again, the 31st day falls on a weekend or on a holiday. Okay? They could go back to 28 if they really want to. Nothing stopping them from going back to a shorter cycle. Well, the normal cycle. Nothing, because Tuesday is not a weekend. Thursday is not a weekend. Friday is not a weekend. You see? Well, let's assume it was on a Monday, James, and Monday was a holiday. So the 31st day was a holiday. So again, they're pushing it for the Tuesday. 32. Which means the Sunday would have been 30th. Saturday would have been 29. Friday would have been 28. 28 is not a weekend. Why don't they have a 28-day cycle then? If the Monday was a holiday. So for the weekend one, why don't they have a 28 or 29-day cycle? Because they are allowed a 28-day cycle. They are allowed a 29-day cycle. 28-day billing cycle, 29-day billing cycle. That is the standard. Why push it? So they prefer to push it by one more day. And again, when you first get a credit card, they have to approve it. You have to activate it. They have to mail it to you. You have to activate it and you have to use it. All this time in between, with regards to the first statement, they're telling us they cannot generate a statement on time. Okay? It's not they can generate a statement, America. These folks, like I mentioned earlier, they understood that sending you a shorter cycle, they'll make less money. That's why they want the cycle to go undisturbed, unimpeded for the balance, for a longer period so they could make more interest, folks. Nothing stopping them from having a 28-day cycle. Last I checked, that was part of the standard. If we want to call it the standard. Nothing stopping them from having a 29-day cycle. This one will be for the weekend one. If the weekend falls on a week, if the 31st day falls on a weekend. Well, they could have a 28, 29. If the holiday falls on a Monday, well, they could have a 28 because Friday will be the 28th day. Friday is not a holiday. Monday was. Again, folks, there is no reason at all for our government to allow the big bank, the big creditors to have an additional day, to be charging us an additional day of interest. Okay? Because all the reason that they laid out, okay, these things don't make no sense. Weekend, I just covered the weekend with you guys. If the weekend is on a Sunday, don't push it by one more day. Walk it back instead. Because 28 days is the standard. Well, we could call it the standard. 29 days is also part of the so-called standard. Holiday, if the Monday is a holiday, well, walk it back to 28 days because 28 days is allowed. Well, James, if we give you a 28 days and your bill is due on the 23rd, okay? Well, how is your bill going to be due on the 23rd? Because we have to give you the payment due date that you want. Because remember, you asked us for a 23rd payment due date. Well, if we give it to you on the 28th, and the 28th so happened to match the same calendar month. Let's say this 28th, just to make our job a little easier, let's say this 28th was also the 28th of the month. Okay, it doesn't always work that way, but you know, I just want to use it just so I could illustrate my point. Okay, so 28. Well, if we work it back, James, you're not gonna get the due date that you want, because remember, you want a 23rd due date. You want your payment due date to be on the 23rd of the calendar month, of the following month. If we close our books on the 28th, 28 plus, and the month has 31 days, 28, 29, 30, 31. Our grace period is only 23 days after the statement closing date. Your statement closes on the 23rd, okay? 23rd, 28 plus 23rd plus 23 days, that is not 23rd. If we close it on to 31st or 32nd, then you could get the payment due date that you want. No, remember, by rules, you have to give us at least 21 days. Okay? So if you have to make up 3 days, okay, that's 1, that's 2, that's 3. So give us at least 24 days. So if it was 23 and you have to make up 3 more days, well, give us 1, 2, 3. Give us 26 day grace period. Because again, by law, by rule, they only have to give us 21 days. But there's no cap as to how long he has to be. Okay? All the rule says is that at least 21 days. At least. So long you satisfy this 21 day, you're okay, big banks, big creditors. Well, James, why they not doing that? Why they don't push the grace period by more days? The payment's still going to be due on the 23rd. If you push the grace period, let's say the billing cycle closes on the 28th, push the grace period by 3 more days. I'm still going to get my 23rd day payment due date. So the big bank, the big creditors, I guess working in conjunction, working in concert with our federal government, because you know these guys, all of them really, I'm talking about the Democrats and the Republicans. Most of these guys are already bought and paid for. Again, folks, there is no reason at all for a billing cycle to be greater than 31 days. Okay? Even working with current law, current rules, they could still give us the payment due date that we want. If they use a shorter cycle, say a 28-day cycle or a 29-day cycle, they could still do it. Okay? Because all these numbers are greater than 21 days, and they only have to give us 21 days, at least 21 days. Okay? Now, to this so-called Consumer Financial Protection Bureau, these people, they're supposed to be the enforcer, but they allow the big bank, the big creditors to be doing this nonsense about charging us interest on a longer billing cycle. To these folks, A, I hope one of them get a hold of this video, okay? And B, If they cannot do the job, they're supposed to be the enforcer. I'm talking about the Consumer Financial Protection Bureau. If they cannot do the job, they need to get out my way and find somebody that could do the job. Okay? Because in 1 second, really, they could change this nonsense. Okay? Because remember, this so-called Consumer Financial Protection Bureau, they could write some rules. They don't necessarily have to even wait for this thing to go back to Congress. Okay? They cannot do laws, but they can write some rules to control some of this nonsense that we got going on, whereby a big bank or big creditors is allowed to charge us on a billing cycle that is greater than 31 days. They could stop it. Okay? And again, folks, these folks, they don't want to go back to a shorter cycle because, again, they make less money. Okay? They make more money on a much longer cycle. Because again, most of us, we're living paycheck to paycheck. Okay? We're not going to break up the balance. So for that reason, since it's an average daily balance, including new transaction with compounding, they prefer the balance to keep compounded, unimpeded, undisturbed for a long period of time. Alright folks, I think I covered this thing long enough. Alright America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. Alright America, now let's keep building this little cheat sheet. So, grace period, payment due date. And just like we have different variation of the billing cycle, we have another variation of this grace period. And this one, another variation of the grace period, this one is interest-free. Grace period. We already had grace period on the board. Now we have interest-free grace period. The interest-free grace period, America, could be up to 55 days. Could also be 56 days. Now, let's keep building this little cheat sheet first. On the board, America, we have 3 separate credit cards. We have credit card A, credit card B, credit card C, and we have an HELOC. And we even have, on the second example, we have credit card D. So let's put credit card A, CCA, credit card B, credit card C, credit card D, and we have the HELOC. This interest-free period, I have 55 days. Where did you come up with this 55 days, James? Remember, America, a billing cycle could be the standard is 21 to 38, 28 to 31 days. So, if we have a cycle that have 31 days, let's use the one with 31. So, 31. Say that you make the purchase on day 1 of the cycle. And the cycle has 31 days, okay? So, you made the purchase on day 1. Purchase day 1. And the cycle has 31 days, okay? So the remaining days between the time you made the purchase and the number of days in the billing cycle, so from 1 to 31, so we have 30 days, so 31 minus 1 is 30. And then most of these lenders might give you about 25 days, okay? So plus 25. Okay? So if you time it right from the day that you made the purchase, if the purchase is on day 1 and the cycle is 31 days, okay, the remaining days before the payment is due, okay, so we got that 31 minus that 1 day because you made the purchase on day 1, so we had 30. 30 plus 25, because most of these credit card companies, they'll give you a 25-day grace period, okay. So now you could have up to 55 days. 31 minus 1 is 30. 30 plus 25 is 55. Okay? And I also put 56 on the board because I see online that people are saying that with regards to a credit card food, it could only be it could be up to 55 days. Well, it could be 56 days as well. Why? Because we have a billing cycle that could have 32 days as opposed to just 31 days. So you'll be 32 this time, minus 1. And again, you made the purchase on day 1 and the cycle is 32 days. So 32 minus 1 is 31. 31 plus 25 days cycle, grace period, okay, will be 56. Okay, so from the time you made the purchase to when your payment is due, these two combined, you could have 55 days. Let's just call the 55 the standard. We could call it 56 days. Okay, and again, our government allows big banks to have 32-day cycle. So if they allow them to have 32-day cycle, how is it only 55? It gotta be 56 if you made the purchase on day 1. Okay. But on our example, we also put down, due to these reasons, a cycle could be shorter or longer than 31, 32. Well, if 32 is 56, well, we have a cycle that could be longer than 32. So that's why I put down or more. Okay? This one's going to be kind of hard because a lot of times on the first statement, you will not know when day 1 is. Okay? When you're changing the due date, it might be kind of hard to figure out when is day 1. And when they're making an adjustment themselves, it might be kind of hard for you to figure out when is day 1 of the cycle. So this one, this more, 55, 56 or more, this one's going to be a little difficult to figure out. Okay? So, but for that reason, we're gonna call this 55 days the standard. Okay, up to 55. But I've just gone over the reason why it could be 56, not 55. Okay, if you go online, everybody talking about 55 days credit card float, 55 days free period, interest free period. Well, it could also be 56 on a 32-day cycle. It could be more than 56. Okay, but 55 is okay. We accept 55. Okay. Okay. Hopefully, when we do a Google search, Google will be corrected and show that we could have an interest-free grace period with regards to credit card greater than 55 days. But anyways, let's accept 55. Folks, by the way, over at Ambroise Method, we are the shepherd, shepherding the flock. Who is the flock, America? Regular Joes, regular Janes, you guys are too busy or too ignorant to fully understand those things. That's why you need to find somebody that truly understands numbers by the grace of God to properly explain things to you guys. Spirit of Father, thank you. All right, America. Now, that was the billing cycle. On the board, America, I have credit card A, credit card B, credit card C, credit card A again, so that's the same credit card. For example, number 2, we have credit card D and an HELOC. The HELOC is the same, credit card A is the same, HELOC is the same. Okay, 11,000, 11,000, same exact thing. Credit card A, 13,000, 13,000. Okay. Now, the interest-free grace period, and again, the interest-free grace period is, I guess, for lack of a better term, could be up to 55 days, 56 days or more. But let's work with this standard, so 55 days. Okay. So they will add items from the billing cycle, and again, this 31, this 32. Well, let's just use the standard. So is the billing cycle. And we have this 25 days max, okay, that most creditor uses, so that's the grace period. Okay. So this interest-free period, America, combines items from the billing cycle and the grace period. Again, this 31 days was the billing cycle. This 25 days is the grace period. Okay? So it travels from the billing cycle, well, it could be up to the billing cycle and the grace period. Again, 31, that's from the billing cycle. 25, that's from the grace period. Okay? So this interest-free grace period combines these two. Okay? So it could be up to 55 when using this example. Okay? So if you got lucky, you made a purchase on a credit card on day 1. Okay? So you're going to have, and they gave you 25-day grace period for a cycle that has 31 days, you're going to have about 55 days interest-free period to make the payment. That's a long time. That is a long time. Okay? Now, going back to the example, credit card A, we say that credit card A has grace period, and this particular lender wants you to pay your statement balance for 2 consecutive billing cycles in order for you to get your grace period. Okay, let's talk about that a little bit. Financial coach, taking my time doing this lesson because I want you guys to fully understand these things. Okay? Credit card A has a grace period, 2 cycle. Credit card A, grace period, 2 cycle. Okay? For some lenders, in order for you to achieve your grace period, you have to pay your statement balance in full for 2 consecutive cycles, financial coach. So, say for example, to make things a little easier, we're going to use a calendar month, just so you guys could follow, because I don't want this thing to be too convoluted. Say it was March and April. And it so happened that, let's use July and August instead. Sorry. To make my job a little easier. Because July has 31 days, August has 31 days. Okay? So, say the statement balance, we're just throwing a number in there. Well, let's just put balance. In order for you to achieve, to get back your grace period, or to have your grace period, because credit card A offers grace period. So you have, say, July 20, let's say 23rd, and August 23rd. Okay? On July 23rd, your balance was X. On August 23rd, your balance was X minus 200. To have your grace period, America, you have to pay for most credit cards, well, for some credit cards, you have to pay your statement balance in full on or before the due date. Again, this thing is due on the 23rd of the month. So July 23rd is due, August 23rd is due. Okay? So whatever that statement balance is, in this case we say it was X, you bring it to 0. That's for 1 cycle. Whatever, then you start using the card again. Whatever the balance is, before August 23rd, you also bring it to 0. So you paid it in full. Okay? So, if you pay your statement balance in full, so you bring it to 0 balance for 2 separate cycles. Okay? For credit card A, now you have your grace period back. Now you have grace period. Okay? So, which means now whatever transaction that you do after you have your grace period, okay, and you continue to pay your statement balance in full, okay, so August 23rd, the following one gonna be July, August, September 23rd, because your bill is due on the 23rd, your payment due date, okay. As long as you keep paying the balance in full after that, okay, you will not get charged any interest. Okay? Why? Because this particular credit card A, wants you to pay your statement balance for 2 consecutive months or 2 consecutive cycles. Okay? in order for you to earn your grace period. Okay, so 1, 2, pay the balance in full. That's 1. Pay the balance in full again. That's 2. Okay. Any other transactions after that, if you keep paying your balance in full, okay, you are not going to incur. They are not going to charge you any interest. Okay. So credit card A has grace period. Let's put down has grace period. So that means interest-free period. Okay, that was for credit card A. Credit card B has grace period, but the grace period, I guess, got dropped or got lost. So let's assume for credit card B, let's use the same criteria. And again, folks, different lenders have different criteria. They don't have to follow the same thing as credit card A. Okay? Credit card B might have a different criteria as to when, okay, you have your grace period back. Okay? And again, folks, our government allowed these big banks, these big creditors to do whatever they want. You got this bank, they all operating under different rules. One might have one rule, another one might have a totally different rule. So let's say credit card B. Credit card B has a zero balance just like credit card A. Even though credit card B has a zero balance, credit card B doesn't have grace period. They offer a grace period, but somehow they dropped it or lost it. Why? Maybe because they are paying the statement balance in full, but it has only been for one cycle. Let's assume they're following the same guidelines this time as credit card A. Remember, for most of them or for some of them, you need 2 cycles. You need to bring the balance to 0 for 2 consecutive cycles. Let's assume credit card B brought the balance to 0, but it has only been 1 cycle. Okay? So in order to have your grace period back, okay, it has to be 2 cycles. But credit card B, so far I've only done it for 1 cycle. Paid the statement balance in full for 1 cycle, not 2. Okay? And again, folks, different credit card company have different rules. Okay? Some of them it's only 1 cycle and you're good to go. Some of them it has to be 2 cycles or more. Okay? But let's say for these two, it has to be 2 cycles for A and B, credit card A and credit card B. Okay? So credit card B has 0 balance just like credit card A. However, credit card B doesn't have grace period. That is this interest-free period. Why? Because they paid the statement balance in full for 1 cycle, not 2 cycles yet. Not 2 cycles total. So far, it's only been 1 cycle. So for that reason, credit card B, we're saying that the grace period got dropped or the grace period got lost. Okay? Even though the balance is 0, folks. So, grace period dropped or lost. Which means when any transactions that you're doing on credit card B, interest is accruing. You do not have this interest-free period, okay? So interest is accruing. You spell accruing. So interest accrued immediately. As soon as the transaction is posted, they're gonna start charging you interest on credit card B, even though credit card B has a zero balance. Okay? And again, for some of these lenders, you have to pay the statement balance for 2 consecutive months. Okay? Credit card B, 2 consecutive months. Credit card A, 2 consecutive months. Credit card B brought the balance to 0, but it only has been 1 month, not 2. Okay? So any additional purchase or purchases, they're gonna start charging you interest. Okay? On the board, we also have credit card C. Credit card C has a 0 balance. But we say that the credit card C has no grace period. So no grace period. Even though he has 0 balance. No grace period. So here they did not offer it. So interest immediate. Let's put down interest. Let's just put immediate interest accrues immediately. Okay. Now, going back, folks, we have credit card A offers grace period, but it has to be 2. You have to pay the statement balance for 2 consecutive cycles. You have credit card B also offer grace period. You also have to pay your statement balance for 2 consecutive cycles. Because credit card B only paid the balance in full for 1 cycle, credit card B, we say that the grace period got dropped or got lost because it had only been 1 cycle, not 2. Okay? And again, folks, different credit cards. For some credit cards, it's only 1 cycle that you need. For some, you need 2. For others, you need more than 2. Okay? So, if you do not know what you have, by the way, that is why paying off debt could be a little bit complex. Because again, our government allowed these big banks, these big creditors to be operating under different rules. They could do whatever they want, man. Anyways. In credit card C, this time, this credit card company did not offer a grace period at all. So, some credit card offer grace period, and you could actually have it, or you could lose it. Others don't even offer it at all. So, which means that this grace period, America, is voluntary. Okay? It's not automatic, folks. Okay? Don't think because you have a credit card, you automatically have grace period. Depends on the lender. Some offers it, some don't even offer it at all. Okay? So gotta know what type of credit card that you have, financial coach. Okay? Okay? This is all voluntary, man. Our government allow them to, they say, hey, we could offer it to you if we want. If we don't want, we're not gonna offer it to you. Okay? Not automatic. So not a requirement. Not a requirement. Alright, folks? Talking about this grace period. I got it on the one line. Put it a little lower. Not a requirement. Alright. Okay, so now what about credit card D? Where's credit card D? D is right here. Grace period got dropped or lost. Credit card D, why? Because credit card D is carrying a balance. All these had zero balance, 0, 0, 0. Credit card D is carrying a balance from month to month. So, credit card D, no grace period got dropped or lost. So just like this one, grace period dropped, lost. So interest accrues immediately, just like this one, just like this one, which is credit card B. B as in boy and D as in dog operate the same way. Interest accrues immediately. So which means as soon as you do a transaction, they're going to start charging. As soon as the transaction is posted, they're going to start charging you interest. Okay? Because they offer grace period, but it got dropped or lost. Why? Because you're carrying a balance from month to month. Okay? 10,000. All right, folks? And finally, we have the HELOC. HELOC doesn't have this interest-free grace period. So HELOC, I just put none. Okay. And again, HELOC is under different rules, folks. They are not a credit card. Okay. So you're not going to have up to 55, 56 or more, but let's use the standard up to 55 days for HELOC. No. For HELOC, as soon as you start making the transactions, you get in charge interest. Okay. So interest, let's just put down interest immediately. Okay. All right, folks, to recap, this interest-free period is voluntary. It's not a requirement, which means a credit card company could give you grace period if they want, or not give you grace period. Okay. Could be 55 days if you make your purchase on day one, and the billing cycle has 31 days. 56 if you make your purchase on day one and your billing cycle has 32 days. So 32 minus 1 is 31. 31 plus this additional 25-day grace period. That's how we're at 56 or more, because sometimes we know a billing cycle could be longer than 31 or 32 days. Okay? But this one's going to be extremely hard to figure out. Okay? So for that reason, we're going to stick with this standard, which is 55 up to 55 days. Credit card A has a zero balance, America. And part of the requirement to have your grace period, to have this interest-free period, is to pay your statement balance for 2 consecutive billing cycles. And the client has paid the balance for 2 consecutive billing cycles. So for that reason, they have the grace period. So they have this interest-free period. Could be 55, up to 55. Could be less than that, but up to 55, since we're trying to stay with the standard only. Okay? Now, credit card B also have a zero balance, but credit card B, the grace period got dropped, or the grace period got lost, which means interest you're gonna get charged interest immediately. As soon as you do a transaction, they're gonna start charging you interest. Why? Because credit card B follows similar route as credit card A, whereby you need to have 2 consecutive billing cycles to pay your statement balance for 2 consecutive billing cycles. However, credit card B only pay the statement balance so far for one cycle, not 2. Okay? For that reason, the grace period got dropped. Credit card C doesn't even offer grace period. I guess they refer to them as subprime credit card. You got credit card that don't even offer grace period at all. Okay? I guess you could call them subprime. Let me put that here. Subprime credit card. Okay? Doesn't even offer grace period at all. Okay? So interest from the day that you made the transaction, as soon as it's posted, interest being accrued immediately. Okay? And we have credit card B, because the client is carrying a balance from month to month. Okay? The grace period, just like credit card B, the grace period got dropped or lost. Why? Again, you're carrying a balance from month to month. Okay? So every time you do a transaction, interest is accruing immediately. Okay? And finally, we have the HELOC. Since we have HELOCs on the board, HELOCs doesn't have this interest-free grace period. Okay, folks? So, which means as soon as you do a transaction, interest is being accruing, so you're getting charged interest immediately. Okay? All right, America. I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America, we have another kind of grace period. This one is late fee grace period. Okay, this late fee grace period with regards to credit card, credit card doesn't have it, so let's just put none here. Which means, say for example, your payment due date is on the 23rd. You did not make your payment on the 23rd, so on the 24th, okay, since they don't give you an additional grace period for late fees, so on the 24th, they're going to start charging you late fees with regards to a credit card. Now, for HELOC, some of them might give you 5 days to 15 days, 5 days to 16 days. Okay? So, your payment was due, let's use the 23rd again. Your payment was due on the 23rd. So before they start charging you a late fee, okay, they might give you an additional 5 days. So 23 plus 5 is 28. Your payment is due on the 23rd. They might give you an additional 15 days. Okay? So 23rd plus 15, let's say is what? 38. Okay, let's say that the month has 31 days in it. So which means your bill gonna be due on the 7th of the following month. So your payment, well, you could make the payment up to that amount. 7th, before you get charged an additional late fees. Okay? And some HELOCs, just like credit card, it's 16 days. Some has none. But most of them offer it, because remember, it's not a requirement. So they don't have to give you this late fee grace period, which is an additional 5 to 15 days. If the 15 days falls on the weekend, just like over here, weekend holiday, so it might be 5 to 16 days. So instead of 15, it might be 16. Okay? And some HELOC companies may not even offer you anything at all. Okay? But most of them that I come across, they do offer a late fee for grace period. Okay? And again, as low as 5 days up to 15 days, or as low as 5 days up to 16 days, if the 15 days falls on a weekend or a holiday. Okay? And very rarely would you find one that do not offer you this late fee grace period. Okay? Alright, folks? So this is additional days that you have. 23 plus 16, we're at 39. Okay? Before you get charged a late fee. Okay? With regards to a HELOC. Now, as far as a credit card doesn't offer that one. So, as soon as you're late, even by 1 day, they're going to start charging you interest. So, here for the credit card, interest is just put immediately. Okay? And for the HELOC, you might have an additional 5 to 15 days, 5 to 16 days. Okay? Alright, folks? That's the little cheat sheet. Okay? This interest-free grace period, HELOC doesn't offer it at all. Interest immediately. Just like with regards to a credit card, this late fee grace period, credit card doesn't have it. So you're late for 1 day, you get in charge interest because they don't offer it. Okay? This one, they might give you 5 to 15. So you're late for 1 day, you're still okay. They're not going to charge you late fees. We're not talking about the interest-free grace period. We're talking about late fee grace period. Okay? As you can see, we have different kinds of grace period on the board, folks. Okay? So don't get them confused. Okay? All right, folks? All right, America? I'm going to start erasing these things in another 5-10 seconds. So I'll give you about 5-10 seconds, America, to take a look at what's on the board. And then we're going to continue with the exercise. Again, America, I remember a quick question financial coach asked me was, James, can you please do a lesson on credit card float? And this one's going to be part 1. At a later time, I'll probably do part 2, okay, because I don't want these lessons to be too long. All right. Now, again, folks, question financial coach asked me, can you please do a lesson on credit card float? So now let's cover credit card float. A credit card float, America, like I mentioned earlier, it is the time between when you make a purchase to when you have to pay for that purchase. So, for example, let's use a 55-day float. Say you make the purchase on day 1. Let me go down here. Okay. So day 1 was the purchase. Okay. And you have to pay for that purchase, say on day 55. Why? Again, if we're using only 55 days, you made the purchase on day 1, and the billing cycle so happened to have 31 days, so 31 minus 1. So 30 days remaining plus 25-day grace period, so that's how we arrive at 25. Okay. That is the credit card float. The way to, I guess, break it down is that any period from when you make a purchase to when you have to pay for that purchase. Okay? So for a billing cycle, that's 31 days. Okay? The remaining days between day 1 and day 31 is 30 days. Okay? Plus, most of these lenders, some of these lenders give you a 25-day grace period to make your payment. So 30 plus 25, and again 55 days, okay? Interest-free period. So the purchase has to be on day 1 for you to achieve this 55-day grace period, this 55 days credit card float. Okay? Now, how hard is it, James, to achieve this 55-day float? This 55-day credit card float? How hard is it or how easy it is? It is extremely hard. Because the only time you're going to achieve it, the purchase for a billing cycle that has 31 days, the purchase has to be on day 1. And how many of you guys know when is day 1? Say for credit card A, for example. When is day 1 of that cycle? Because you remember, the billing cycle fluctuates a lot of times. Okay? So you have to keep a tab on when is day 1. Okay? So one cycle, day 1 might be one date. If we try to measure it with the calendar date, if we try to match it with the calendar date, okay, day 1 might be a different calendar date. Okay, So it is extremely hard to keep up with this day one of the cycle. So for that reason, it is extremely hard, okay, to achieve this 55-day credit card flow. Okay. So you have to keep watching it, and then trying to make the purchase, okay, on day one. Okay. Let's say for credit card A, because credit card A has grace period. Okay. And going back to how hard it is, remember, some of those credit card companies don't even offer grace period. So that means you're not going to achieve this interest-free float period because they don't even offer it. They don't offer grace period, folks. Or you dropped it or you lost it. Okay? Because remember, all these things are voluntary. Okay? There's no federal guidelines or federal law that say that they have to give you a grace period. Okay? So, this 55 days is extremely hard. Why? A, you may not even have an interest-free period. So if you don't have it, it doesn't matter. If you make the purchase on day one, financial coach, because you don't have a grace period. For whatever reason, either they never offered it, or they offered it, but you're not meeting their specific requirement, because each of those credit card companies, they got different requirements as to when you have your grace period, like Wilford mentioned. Okay, folks? So extremely hard. So when I see these people online talking about, oh, you know, you could take advantage of the float. That's if they offer grace period in the first place to begin with. Because if they don't, interest is being accrued immediately. You're being charged interest right away. Doesn't matter if you make a purchase on day one. Because you don't have interest-free period at all, folks. So extremely hard. First, you have to figure out, do they even offer it? Okay, yes, they offered it. Okay, but when is actually day one? Because day one fluctuates. It doesn't stay the same. Okay. And let's say you got lucky. You did it for the first cycle, doing one period. And then the following period, you forget to keep a tab on it. Okay. I mean, there are ways where you could kind of figure it out, but it's extremely hard because you got these lenders, okay? They might say, oops, I made a mistake, so I need to make an adjustment. Okay? All of a sudden now, everything is out of whack. Because you don't know what they might do from cycle to cycle. And again, folks, our government allow the big creditors to do whatever they want. And earlier we talked about how there's the standard, which is 28 to 31 days. We're talking about how they might have a weekend, holiday, leap year, 28 to 32 days. And we're talking about first statement. We talked about when you're changing the due date. And we're talking about adjustment. Which could be shorter or longer. For those reasons, the billing cycle could be shorter or longer than 28, 30 days. So far I have 1, 2 reasons, 3 reasons, 4 reasons, 5 reasons, 6 reasons, 7 different reasons as to why my billing cycle might change, as to why my billing cycle might be different. 7 reasons so far. Okay. And again, folks, there might even be more that I'm not even aware of. Okay. Again, 1, 2, 3, 4, 5, 6, 7. weekend, holidays, leap year. First statement, when you change the due date and when they're making an adjustment. So 1, 2, 3, 4, 5, 6, 7. So when you take a look at it, in a past lesson, I've gone over all the different formulas that a lender could use on how to arrive at the interest cost for the cycle. And I think I arrived at like 10 different formulas for interest cost. And what do they charge interest cost on? They charge interest cost mainly on the billing cycle. Well, for the billing cycle, they have 7 different ways. So interest cost 10, billing cycle 7. At least 7. There might be more that I'm not even aware of, like I aforementioned. Again, our federal government, well, Congress, truly, well, it seems, is already bought and paid for. Okay, they let those big bank, the big creditors of America to do whatever they want. 10 different ways on how they arrive at interest costs. From a past lesson, we cover all these items extensively. And now for the billing cycle, we have 7 different reasons. So as the regular Jane, regular Joe, that's a 10 plus 7 is 17. I need to memorize 17 different ways. Well, just about, because some of them kind of run, I guess, together, but so 17 would not be a current, a right number. Well, anyways, so going back to how hard, you could see how hard it is. First, they have to offer it, and when they do offer it, you have to figure out when exactly is day 1 of that cycle if you're trying to achieve these 55 days. Okay. All these YouTubers online talking about, oh yeah, it's 55-day cycle, 55-day cycle, 55 days credit card float, 55 days credit card float. Do you even know how to get to this 55 number? I'll say 99% of you guys do not know how to arrive at this 55 number. Okay. So hopefully after this lesson, okay, that percentage will go up a little bit. Alright folks, so extremely hard to achieve these 55 days. Okay, not easy at all. Alright, now on the board, America, we have electricity, the day of the cycle 26, water, YouTube TV, Netflix, cell phone, beauty and skincare, clothes and shoes, insurance, fuel, dining at a restaurant, and groceries. So, the day of the cycle, not the calendar date, but the day of the cycle, 26, fuel, gas, we do not know. We're going to try to figure that out. Dining at a restaurant and groceries, we're going to try to figure out these 3. Okay? So all these are on the 26. Let's put on the board all other bills or expenses. Okay? Because all these have the same, got released on the same day of the cycle, the 26th. Fuel, gas, $380 is $380. Let's say fuel, gas for the vehicle. Let's assume you put fuel on day 7. Let's let's say day of the cycle. Let's put here day of cycle. Let's say you put fuel on a vehicle on day 7th of the cycle. Let's say you put on day 14th of the cycle. Let's say you put fuel on a vehicle on day 21 of the cycle. Let's say you put fuel on a vehicle on the 26th of the cycle. Okay? And all these other bills were on the 26th. Okay? Put that a little bigger on top. So 7, 14, 21, 26. Okay? Now, fuel America was $380, but all these other bills, let's add them up. If they were on the 26th of the cycle, we have $450 on the 26th, $105, $85, plus 10, plus 200, plus 500, plus 200, plus 350, plus 200, plus 350. So we are at 1900. Okay? So all the bills, 1900, because all of them, the day of the cycle is the 26th, okay? Fuel, 380, let's say on the 7th, so 380 divided by 4. So $95. So 95 on the 7th day of the cycle. So these are the day of the cycle. Okay? So 95, 95, 95, 95. Okay? That's how we arrive at 380. And again, 380, let's assume we put fuel on the vehicle on the 7th day of the cycle, on the 14th day of the cycle, on the 21st day of the cycle, on the 26th day of the cycle. Okay? Dining at restaurant, 220. Let's say we dine out, so this one is 4 times. Let's say we dine out twice per month. So 220 divided by 2, looks like 110. Let's say we went out to the restaurant. On the 14th, every 2 weeks, and on the 26th. Okay? So 110 plus 110 is 220. 95, 95, 95, 95 times 4 times is 380. And we have groceries, $500. So we got groceries. Let's say we wait on day 26 to go shop for groceries, so $500. Okay. All right, folks. So we got that one, that one, that one. Okay? Now, so on the 7th, we have total 95. Okay? On the 14th, we have 95 for fuel and 110 for restaurants. So on the 14th day of the cycle, we spent 95 plus 110 is 205. Okay? On the 21st day of the cycle, we have just 95. And on the 26th day of the cycle, we have 1900 plus 95 plus 110 plus 500. We are 2605. Okay, so 2605 plus 95 plus 205 plus 95 is 3000. Perfect. My numbers are perfect. Okay. And again, all these items could go on a credit card, folks. Credit card, 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 credit card. Okay. All these items could go on a credit card. All right. Again, question financial coach asked me, James, can you please do a lesson on credit card float? Okay. I didn't even bother to put the other items that cannot go on a credit card because it wouldn't matter. Okay. So only the items that could go on a credit card because we're talking about credit card float, folks. Okay. And these are the expenses. When you add them up, 3000. Okay. And these are the days in a cycle. Okay. Not the calendar date, even though sometimes if you're lucky, the calendar date may also match the day of the cycle. Say that 7th day of the cycle could also be, say for example, July 7th. The 14th day of the cycle could also be July 14th, but it's extremely rare for the day of the cycle to match, okay, the calendar date. You know, it could happen, you know, but very rarely, okay? All right. So we have our breakdown for the expense. Now let's have our breakdown for income. Okay? Because remember, when we're talking about credit card float, it is the time between when you made a purchase to when you have to pay for that purchase. Okay? And when those people are referring to the so-called riding the float, okay? Remember, you made the purchase, you have to pay for the purchase at a later time, okay? So it is paying for the expense or expenses so paying for current expense with future income. Okay, that's the best way I could define it. Or paying for past expenses with current income. Okay, so past expense, current income. Current expense, future income. Okay, why I prefer that definition of it, because when we're talking about credit card float, the purchase usually comes first. Well, that's the expense. Okay, and you pay for that expense at a later time. Well, that's the income. Okay, so since the expense comes first, so we're paying for that current expense with future income. Because remember, we have to pay for that expense when you're taking advantage of the float 55 days later. Okay, so future income. Okay, now if it was a past expense, well, with current income. Okay, all right, folks, this is the best way I guess I could kind of, there's like different definition, you know, online, but this is the best one. Okay, to follow the same logic, the same order that those things happen in. Okay, Expense come first, income afterwards. Expense, income. Okay. Day one, that's when you make the purchase. Okay. Well, that's the expense. Okay. Day 55, when you have to make the payment. If we're using up to 55 days, that's when the income comes in to pay that expense. Okay, folks? All right. Now, on the board, America, we have credit card A, credit card B, C, the HELOC. Credit card A, credit card D, HELOC. So we have credit cards and HELOC. So with regards to the HELOC, okay, the day will be day 55. Let's put 55 here. Okay. If we're gonna use the HELOC, okay, to fully take advantage of the float. Now, if we're gonna use a credit card, okay, a credit card cannot take advantage of the float because, say you pay, remember the only credit card we have on the board is credit card A. The only credit card that has a grace period. To take advantage of the float, America, you have to have grace period, because if you don't, they're going to start charging you interest right away. So the only time truly you could take advantage of this grace period, of this float, is when you have grace period. And credit card A on the board is the only credit card that has grace period. Okay. Now, you could make all these purchases on credit card A. And it doesn't matter because 55 later, you're going to pay the statement balance in full. Okay? So that's why we have this 55 over here. So you're not going to get charged any interest on credit card A. Since we have two examples on the board, let's say this one is credit card D. Okay? Well, you cannot use credit card A to pay these bills and then send the income to credit card D, because a credit card cannot pay another credit card. Instantly. You cannot use a credit card to pay another credit card instantly. Now, there are still creative ways whereby you could pay a credit card with another credit card, but we're talking about instantly. You cannot pay a credit card with another credit card. Okay? So this one, the HELOC could use credit card A first for the expense. So the income could sit inside the HELOC for 55 days. Okay, so how much would the income be? Well, the income gonna be exactly what the expense is. So the expense is 3,000, so the income will be 3,000. Okay, folks? And again, when we're talking about credit card float, we're talking about paying for an expense with future income. Well, see, if the expense is 3,000, future income will also be 3,000. Okay, folks? So which means credit card D gonna also have 3,000. Because we're gonna try to figure out, okay, if we are better off to take advantage of the float, or if we are not better off to use the HELOC. Okay. Now, the way it's gonna work, because credit card A has grace period, and that's the only credit card on the board that has grace period. Credit card B, grace period got dropped. Credit card C doesn't have grace period. Credit card D doesn't have grace period because the grace period got dropped. So the only account that has grace period is credit card A. Okay? no matter which example we're looking at. So let's take a look at example 2 this time around. Okay. So on the 7th day of the cycle, you're going to spend 95 bucks. Well, you're going to charge credit card A. $95 on the 7th. We say on the 14th, 95 and 110. So 205, we're going to charge credit card A, 205. We say on the 21st day of the cycle, 95 bucks again. We're going to charge credit card A. We say on the 26th, $2,605. We're going to charge credit card A. Okay? So the expense, so altogether, $3,000. So we're going to charge credit card A, $3,000. Okay? And 55 days later, if we were lucky to do all these transactions, to have the income comes in on day one, because sometimes the income does not come on day one, because we have some folks who are on a bi-weekly pay period, okay? But since we're talking about the maximum float, let's assume that all of the income comes on day one, like they were on a monthly pay period. So all these 3,000, and again, 3,000 expense, 3,000 income, because we're trying to pay the expense with future income. So the income has to match the expense. Okay? So 3,000. So credit card A on the 7th, 95 bucks. Credit card A on the 14th got 205. Credit card A on the 21st day of the cycle, 95. Credit card A on the 26th day of the cycle, 2605. Okay? Why credit card A? We cannot use any other credit card to achieve the so-called 55-day interest-free period, because these other credit cards do not have grace period. Okay? So, credit card A, if you're going to use the HELOC, $3,000 total at some point, that's the expense. And you're going to pay credit card A in full. Okay? Again, this is riding the float. Paying for current expense with future income. There goes the expense. Where is the income going to come from? Going to come from the HELOC. How much? 3,000. Okay? On day 55, if we're trying to take advantage of the full credit card float. Okay? Alright, folks? Now, let's see how much money we were able to save for having the income stay inside the HELOC for up to 55 days. Okay? And then again, we assume that this person is on a monthly pay period, so all the income comes in all at once, 3,000 bucks. Okay, why 3,000? Again, we're trying to match how much the expense is. Okay? So the income was in the HELOC for on day one, 3,000. Okay? To achieve this maximum float of 55 days. So day one, and again, billing cycle is 31 days. So 31 minus 1 is 30, plus an additional 25-day grace period. So that's how we got that 55. Okay? Interest-free period. Okay? So, let's figure out the computation. How much we're able to save. If an income stays inside the HELOC for up to 55 days. I'm doing this lesson extremely slow because I'm trying not to lose anybody. On the HELOC, America, they are charging 7%. Okay? Most of these companies, let's see how much 7% is. So we have 7%. That's HELOC. So 7 divided by 100, let's see what the daily is, divided by 365. So we are at 0.001917808. That's what 7% is. Again, the HELOC, 7%. 7 divided by 100 divided by 365. Okay? How much was the income? The income comes on day 1 and it stays inside the HELOC for 55 days. Okay? Before the HELOC release it to pay credit card A, because credit card A gonna take care of all these bills. Okay? So times the number of days was 55. Okay? And the amount was 3,000. Okay, folks? So let's see how much that is. Times 55 days, that's how long 3,000 stays inside the HELOC from day 1, plus taking advantage of the float, a float of 55 days, times 3,000. Okay, we are at 31. 31.64. Okay, folks? That's taking advantage of the credit card float. Okay? Instead of paying all these bills, financial coach, with the HELOC, you're gonna instead pay all these bills with credit card A. Okay? That way the fund sits inside the HELOC for much longer, undisturbed. Okay? In order to take advantage of the float, in order to ride the float. Okay? Because if we use the HELOC instead, well, on day 7th, the HELOC has to pay 95 bucks. On the 14th, the HELOC will have to pay 205. On the 21st, 95. See? And we already know from past lesson, if we kept the income inside the account for much longer, okay, we'll achieve greater results. Okay? So for that reason, instead of paying these expenses with the HELOC, we're going to instead pay these expenses with the credit card. And it doesn't matter because we have grace period on that credit card. So long that we pay the statement balance in full on or before the payment due date. Alright, folks? So the credit card again gonna take care of the expense. The HELOC gonna make the payment to that credit card. Okay? So how long the income gonna stay in the HELOC? For 55 days. Because in this particular example, our maximum float was 55 days. Okay? Now, let's compare it to credit card D. Credit card D doesn't have, remember, we cannot pay a credit card with another credit card. So in that case, credit card D, you have to release the funds. When the bill is due, because remember, we cannot use credit card A. So credit card D has to take care of all those things. Credit card D on the 7th, okay? It was $95. And if the payment comes in, if the income comes on day 1 and we have to release it on day 7th of the cycle, 7 minus 1 is only 6 days. Okay. For credit card D again, 205. If you have to release it, this one is 95. 205. If you have to release it on the 14th, and again, 14th America is 14 minus 1 is 13 days. And again, the income comes on day 1, you have to release it on day 14th. Between day 1 and day 14th, we are at 13 days, so 14 minus 1. Okay? Credit card D again, still credit card D. $95. This one, day 21, which is 21 minus 1. Okay? And again, the income comes on day 1. For credit card D, you have to release it on day 21. Between day 1 and day 21, we are at 20 days. Okay? And then one more. 26 minus 1. Again, income comes on day 1. You have to let it go. Release it on day 26 to pay this expense. That expense is $26.05. Okay, folks? So, D is 1, 2, 3, 4. 95, 1, 2, 3, 4. 1, 2, 3, 4. Okay? But credit card D, the interest rate on D was 29%. Well, let's figure out what the rate is on credit card D. 29 divided by 100 divided by 365. So we are at 0.0007945, 205, 0.0007945, 205. Okay. 0.0007945, 205. 0.0007945, 205. And again, credit card D is at 29%. 29 divided by 100 divided by 365. Okay. For the HELOC doesn't have this breakdown. 95, 205, 95, 2605, 95, 205, 95, 2605. The HELOC could wait and allow credit card A to take care of everything and only worry about making one single payment of $3,000. Okay? Credit card D doesn't have that luxury. Credit card D has to pay all these expenses by itself. Okay? So now let's run our numbers here. 0.007945205 times 7 minus 1 is 6 days. Again, income comes in on day 1. Income, you have to release the income on day 7. Okay, so that's 6 days. And how much was it? $95. How much was it? $205. How much was it? $95. How much was it? $2605. Okay? So let's figure these numbers out. So 0.29% divided by 365 times 6 days. And again, between day 1 and day 7, that's 6 days remaining, times 95. So we are at 0.45. 0.45. Okay? Same thing. This one times 13 days. 14 minus 1 is 13. 13 days times 205. 205. Okay? So we are at 212 for the credit card. This one is a HELOC. Okay. This one, 21 minus 1. 21 minus 1, day 1, is 23. Times 23 times 95. 95. We are at $1.74. And this one, on the 26th day, we have to release it. 26 minus 1, okay, is 25. 29% divided by 100 divided by 365 times 25 times 2605. So we are saving for keeping the income that long inside the credit card. This is how much we're saving. Okay. So now let's add them up. 0.45 plus 212 plus 174 plus 5174. We are at 5605. 5605. Okay, let me do my computation one more time, making sure I did not make a mistake. 29% times 6 times 95, 0.45, 0.45. 29% times 13 times 205, 212, 29% times 20 times 95, 151, 151. Do it one more time. 29% times 20 times 95, 151, 151, okay. 29% times 25 times 2605, 5174. Okay, so let me do my addition one more time. 0.45 plus 212 plus 151 plus 5174. 5582. 5582. Savings. Okay. So, let's take a look at the results, America, real quick. The HELOC, 55 days, takes advantage of the entire flood period, 55 days on 3,000, okay? And on that day, you're going to move the money back to the checking account to pay the credit card, to pay the statement balance on the credit card. This time it's going to be credit card A. Now, for keeping the income inside the HELOC for that many days, okay, your savings will be 31.64. Okay. A credit card cannot pay another credit card, so we have to use credit card D. Okay. Because if we use credit card A, if we send the income on credit card A and we start using, on credit card D, if we send the income on credit card D and we start using credit card A, well, we won't have money to pay credit card A. Okay, so we have to send the income in credit card D and pay those bills with credit card D. Okay, and again, 7 days minus 1 is 6 days. 14 minus 1, 21 minus 1, 26 minus 1, because the income comes on day 1 and we have to release it on those days. So the remainder days is whatever the number of the day we have to release it minus day 1. Okay. So when we have the average daily times the number of days, we have to keep the income inside the credit card before we release it. And how much we have to release on day 7, 95, on day 14, 205 again, on day 21, 95, on day 26, 2605. Okay. And when we add them up, for keeping the income inside credit card D for 6 days, we save 45 cents. For keeping the account inside credit card D for 13 days, we save $2.12. For keeping the income inside credit card D for 20 days, we save $1.51 on $95. For keeping the income inside credit card D for 25 days on 2605, because on the 26th we have to release that money. We have to let it go. Okay, we have to pay for those expenses. Okay, we save 51.74. Altogether, we save 55.82. Okay. So with the HELOC, if we take advantage of the float and send the income to the HELOC, we're gonna save 31.64. Okay. If we send the income instead to the credit card, when we break it down, it's going to be these numbers. When we add them up, we're going to save altogether 55.82. Okay? 55.82, America, is a bigger savings than 31.64. So, do we have to take advantage of the float or not take advantage of the float? If that is how you're going to run your numbers, do not take advantage of the float if that's how you're going to run your numbers. Okay? So, since the savings for the credit card is a lot greater, a lot bigger, a lot larger than the savings on the HELOC, so we are not going to send the income to the HELOC. We're going to send the income to the credit card instead, if that's how you're going to run your numbers. Okay? Now, James, is there a scenario, or is there ever a scenario whereby when you're taking advantage of the credit card float, that the HELOC will be on top, the HELOC will be ahead? Is there ever a scenario where the HELOC will be ahead? Okay? Talking about a credit card float. Okay? Financial coach, I have to be transparent. Yes, there are some scenario where the HELOC will be on top. Why? Because remember, a lot of times we're measuring if you're able to take advantage of 55 days, okay? It's gonna be 55 days against, this one was like against 6 days. It's gonna be 55 days against 13 days. Again, 55 days against 20 days, 55 days against 25 days, okay? Depends how much of the expense that you have to, how much income you have to release on what day, okay? Sometimes a HELOC will be on top, okay? Depends on the example, okay? This is why I'm calling this one part 1, credit card float part 1, and somewhere down the road, you know, if I remember, I'll probably do a part 2, okay? To show you guys that sometimes the HELOC will be ahead, okay? Why? Because the float, the number of days in the float is so large, man. Look at this one, 55 days, okay? When you could be comparing 55 days with like 3 days, when you could be comparing 55 days with 6 days, 9 days, 12 days, okay? So this number, because it's so big, sometimes it might make a difference, okay? Okay. And if I remember, we'll cover all of that in part 2, credit card float part 2, okay? But again, if you're gonna run the numbers the way that I'm running them now, okay, collectively, okay, the credit card will be ahead. And again, the saving on the credit card, 55.82. Meanwhile, the saving on for the HELOC, 31.64. 55.82 is bigger or better or greater than 31.64. Okay? If you're gonna do everything you're gonna run everything collectively in that manner, okay? And whatever the difference of whatever nuances, I will cover that if I remember on part 2, folks, okay? When the HELOC is ahead, okay? This is one of the few instances where the HELOC will be ahead, okay? We're gonna cover that again in part 2, okay? Because I don't want this lesson to be way too long, okay? All right, folks, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. Earlier, I mentioned that one of the items that we're going to cover today is consolidating the due date or the due dates of your bills expenses. Okay. Like this one, all the bills or expenses, they have different due date. Okay. This one is the day of the cycle on the 7th, but the 7th day of the cycle still has to correspond to a day, to a calendar date. Okay. To make our job easier, let's assume they were the same. So sorry about that. So let's assume the day of the cycle was the same as the calendar date. Okay, because all these on the 26th, let's assume the 26th day of the cycle was also the 26th day of the day 26 of the month, calendar month 26th day. Okay, fuel gas doesn't have due dates, but we still have to account for these expenses on certain day of the cycle. And since we saying that the day of the cycle is also the same as the calendar date, just to make our job a little easier. Okay, so in this case, then the 7th day of the cycle will also be the 7th of the month. Say we're in July, so this will also be July 7th, July 14th, July 21, July 26th. Okay, but again, it's the day of the cycle. Very rarely that they match, they are the same as the calendar date. Okay, so all these will fall on a calendar date. Okay, so this consolidating the due date of your bills or expenses. For example, on the 7th, all these bills $95. On the 14th, $205. On the 21st, $95. On the 26th, $26.05. So we have all those different day of the cycle, or all those different calendar date. Okay, when we're talking about consolidating the due date, okay, so all those different due dates, we're gonna consolidate them into one single due date. Okay, because remember, we put in all those different due dates or all these expenses on credit card A. Okay, so the HELOC is not going to be paying these items on the 7th, on the 14th, on the 21st, on the 26th. The HELOC gonna release the funds when the credit card is due. So when credit card A is due, that's when the HELOC gonna release the fund back to the checking account to pay the credit card. Okay, so credit card A gonna take care of all those different due dates. Meanwhile, the HELOC only has to worry about one due date, just the due date for credit card A. Okay, so this is what we meant when we're talking about consolidating the due date of your bill and expenses, is to take all those due dates, okay, and pay them on one single day, which is the day that the credit card is due. Okay, that is consolidating the due date of your bills or expenses. Okay, we're not gonna be chasing all those different due dates when we're taking advantage of a float. Okay, we're gonna allow the credit card that has grace period to take care of all these due dates, and all we have to worry about is to pay the credit card on its due date. Okay, all right, folks. If you could have automatic payment to where you don't have to worry about those things. If you could, okay. And on the due date of the credit card, that's when you make the payment. Okay. But if you cannot, okay, keep consolidating those due dates to where the credit card is the only remaining payment that you have to make from the time the income comes in to the time you have to release the income to pay for the credit card. Okay, folks? I hope I explained this thing clear enough. That is consolidating the due date of your bills or expenses. Okay? You dump all this due date into the credit card that has the grace period, so later on you only worry about just this due date. on the credit card. Okay? When you have to release the income from the HELOC to take care of the credit card. All right, folks? Now, James, earlier you mentioned that there are a few instances when the HELOC will be on top. Well, how then do you account for scenario like this? Okay. Remember, on our method, America, the steps for our method is let's put it over here. Is segregate, compare, transfer, repeat. And you stay above the line for as long as you can before you move downstairs, before you move below the line. And below the line, we have to answer some questions. WHT, which account or accounts to choose, how much of a payment to send to these accounts, and to pay down or off which debt or which expenses. Okay. These are the steps for Ambroise Method, folks. Okay. And then we have the C.A.R.E. Okay. We have C for condition, A for adjustment, R for restrictions, and E, that's the C.A.R.E., E for exceptions. Okay. So what was the condition? If we have a scenario whereby we have to take advantage of a credit card float, and because the number of days is so large on the float, if you're able to achieve that kind of float, okay? So if, okay, for whatever reason, the HELOC will be ahead, okay? So then you have to make some adjustment to the strategy, okay? Or you have to make an exception, whichever one. Everything is covered in the C.A.R.E., folks, okay? Everything is covered, okay? Again, remember, we are, the way our saying goes is that Ambroise Method is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost. Greater results. Well, say for example, the HELOC will be $31.64 and the credit card, say it was only 45 cents. Well, the HELOC will be ahead. Okay? Remember, we want to offer greater results in terms of reducing interest costs. Okay? Or in terms of interest savings. Okay? We always go where we have the most, where we have greater results for interest costs. Okay? Or greater results for interest savings. Okay, folks? All right? Because once in a blue moon, okay, because we're talking about, again, a float period that is so large. In this example, if you're using them collectively, the credit card is ahead, $55.82 minus $31.64. But like I mentioned, there are some scenarios, okay? Even in this example, I could use a different scenario, okay? I don't want to get too far ahead of myself because we're going to cover that in part 2, folks, okay? Where the HELOC will be ahead, okay, in terms of interest savings. But in this example, the way that we use our numbers collectively, the credit card was ahead. Okay? All right, Marco, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, Marco. Now, we have 2 examples on the board. Example 1, example 2. On example number 1, okay, the HELOC is the only account with a balance, okay? So in a scenario like this, and we still have the same bills, the expenses, in a scenario like this, okay, you take advantage of the float by using credit card A, and then you dump all of the income, like my competitor like to say, on day 1 onto the HELOC. So for example 1, absolutely, go ahead, take advantage of the credit card float. For example 2, this time we have 2 accounts with a balance. Okay? If you try to take care of everything collectively, well, you are better off using credit card D. And again, credit card D has a greater savings than the HELOC. If, here goes the condition, folks, if you try to dump everything onto credit card A, okay? And again, to be transparent, okay, there are scenarios where the HELOC will be ahead. Those scenarios we're going to cover in part 2, credit card float part 2, okay, folks? Which is going to come somewhere in the future. Okay. All right, America. I think that's it for me today. Again, my name is James Ambroise. I am the author, creator of Ambroise Method 1.0 and Ambroise Method 2.0. Ambroise Method is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to debt snowball, debt avalanche, velocity banking. Thank you, Jesus. Until next time, America. Good morning.